Hey everyone, and welcome to today's Explainer. We are going to be looking at the absolute nuts and bolts of how mutual fund investing actually works, and we're going to do it by breaking down a really detailed case study. Let's jump right into the structure and flow of a typical fund. So, I have a question for you. Do you want a simple way to invest in a beautifully diversified portfolio? Look, even if you are glued to the markets every single day, the daily grind of picking individual equities and constantly rebalancing your assets, it can be a massive drain. Sometimes, honestly, just handing your capital over to a dedicated professional is the absolute most efficient path to long-term growth. Okay, let's dive into this with Section 1, the mutual fund basics. Basically, a mutual fund is just pooled capital. Think of it as a giant basket filled with a collection of stocks, bonds, cash, and other securities, all managed by a dedicated professional. Rather than you having to sit there executing dozens of individual trades and sweating over your own allocations, you just deploy your capital into this pre-structured, professionally curated portfolio. It's the perfect solution if you want immediate diversification without all the operational heavy lifting. Moving right along to Section 2, setting up Will's Fund. To really picture how this operates, let's follow a guy named Will. Will is a seasoned trader who decides he wants to formalize his strategies so he can manage outside capital. To pull this off, he goes through a very concrete, step-by-step regulatory process. First, he registers with the financial authorities. Then, he gets his official approval. And finally, boom, he formally structures his vehicle, which we are just going to call Will's Fund. Now, Will needs cash, right? He leverages his awesome track record to convince 10 of his friends to invest. They each commit to putting in $1,000. So, doing the math, Will's Fund officially launches with a $10,000 initial pool of capital. All right, let's get into the jargon in Section 3, understanding NAV and AUM. Now, what's really interesting here is NAV, which stands for net asset value. This is literally just the price tag of each individual share in the mutual fund. Since that total initial pool is $10,000, spread across 10 distinct shares from his friends, the starting net asset value is exactly $1,000 a share. So, what does Will actually do with that 10 grand? Well, he gets to work deploying it. He allocates a good chunk into various stocks for growth, he grabs some bonds to secure steady yields, and of course, he deliberately holds a percentage in liquid cash reserves just to be safe. So the crucial point is that this whole pie, the stocks, the bonds, the cash, all bundled together, that entire portfolio represents what we call assets under management, or as you'll hear it called constantly on Wall Street, AUM. And you know, professionals don't work for free. For actively managing this portfolio, Will charges an asset under management fee. It's just a tiny standard percentage taken out of the fund to cover his operational costs, his research time, and his ongoing expertise. Let's move to Section 4, Growth and Close-Ended Funds, and see how this builds. Let's fast forward a bit along our timeline here. In month 1, the initial investments are made. By month 2, Will's allocation strategy really starts paying off and he executes some super wise stock decisions. And by month 3, he's generated an additional $1,000 in profit and capital appreciation. Not bad for a few months' work. So let's look at the before and after. Back in month 1, we had 10 shares, a $10,000 total pool, and a $1,000 NAV. Now in month 3, with that sweet new profit, the total capital pool is $11,000. Divide that equally among the 10 shares, and the fund's new net asset value is up to $1,100 a share. Every single friend made $100. Now this brilliantly illustrates a very specific setup. Will structured this vehicle as a closed-ended fund, meaning he raised the initial money from his specific group of friends, and then he firmly shut the door. He is absolutely not issuing new shares or accepting any more funds from outsiders. The share count remains totally fixed. Because the fund is closed-ended, what happens if one of those friends wants to cash out? Well, they cannot sell their shares directly back to Will's fund. No way. Instead, if an investor wants liquidity, they literally have to seek it out on the secondary market. They have to trade their position to another willing buyer, usually out on the open stock exchange at whatever the current market price or NAV happens to be. We've traced Will's fund all the way from pooling the initial capital to the NAV growth and finally to secondary market liquidity. It really highlights the incredible efficiency of pooled investments. But honestly, demystifying this math leaves us with a much deeper question to think about. In today's era of AI-driven trading and super low-cost passive index funds, is that traditional active manager's fee still justified by their returns, or are we just paying for a financial structure that we don't even need anymore? Something to think about. Thank you so much for joining me for this explainer, and keep exploring.